Welcome to the Investing Ahead podcast. I'm Tom Curran. I'm pleased today to have as my guest my son, Kevin Curran. He is our co-CEO and Chief Investment Officer at Curran Wealth Management. Before we go too far with this, I'd like to tell a little story about my boys. There are two of them, one here and one not in the business. But the one who's not in the business, he was once asked what his father did for a living, and he said, "My father sells socks." And so that might explain why he's not here today. And Kevin is the son who's part of the podcast. Kevin is a certified financial analyst. He's a graduate of NYU Stern School of Business, Lafayette College graduate, and he's worked in the financial services industry from the first day out of college, just like I did. It was basically the only business I've been in. Kevin started with Lord Abbett, a mutual fund firm. He went to Salomon Brothers Asset Management, Deutsche Bank, and after he got all that youthful exuberance out of his system, I decided it might be time to bring him on board at Curran Wealth Management. Now, Kevin, his primary role on a day-to-day basis is he's our Chief Investment Officer, which is the person who selects our securities for investment. We're a little unlike, I think, most advisors who typically hire outside managers. We are also an investment management firm, and shouldn't surprise anyone why our first name was Curran Investment Management, because we were really investment managers. And we went from that to wealth management, which is broader service to include doing business with the public, people like you. Since we started Curran Wealth Management, we also added an accounting business, which we call Hippo Tax Services. And I was asked when we named Hippo, why we did that. That seemed like a little bit of an unusual name for a tax business. But I said, if Apple can be Apple and Google can be Google, we can be Hippo. So we got into the tax business as well. But Curran's primarily, our focus in the early years was investment management. Now, Kevin, I want to talk to you a little bit about what we do and how we invest and the kinds of companies we choose. So why don't you tell us first a little bit about our flagship investment, which we call Core Growth.
Sure. I'm happy you covered my investment industry journey before working for you, because I had to learn all the ways not to do things before I could. So it's sort of, if you're going to deconstruct something, you need to know how it works on the inside first, because we certainly don't approach things the way any of the predecessor firms I worked at do.
Kevin, I'm glad you said that, because I said exactly the same thing. Maybe you've heard it from me too before, that I learned all the things I didn't want to do once we went into business as Curran.
Yes. It's interesting too, because when talking to professional investors and showing them what we do, they're not really interested in the results, which are very good. They're more interested in pointing out how we're different and, oddly enough, rejecting the process, despite the fact that it works and has worked since we started in 1998 doing this together. The core foundational investment for Curran is our core growth strategy. How is it different? It can't be put into a box, which is how often people try to look at things, to describe things. It makes it simple if you can put it in a box and compare it, this box versus that box. We defy that and start with the notion, well, we don't need to own a lot of companies. We just need to own the best companies. So the portfolio consists of 20 to 25 positions across different sectors. It tends to be concentrated in information technology, healthcare, and consumer discretionary. The reason for that, they tend to offer the best company-specific returns, and then within the sectors themselves, you find the widest disparity of returns. So if we're doing our job well, we're picking not only the sectors that are doing the best, but we're picking the companies that are doing the best in those sectors. Those companies tend to have long runways for growth. So our time horizon for owning them is very long. We're looking at a typical holding period of 5 years or more, which for this industry is considered long, low portfolio turnover, commitment to the companies. For a taxable investor, that's beneficial in the sense that there's not a lot of churn, and hopefully we're doing better for the investor on an after-tax basis, not only as well on a relative basis versus the S&P 500.
Kevin, let me interrupt here just for a minute. What does this mean for our investors? Lipper is probably the best known evaluator, measurer of data. Let's call it performance for investment managers in our business. Lipper ranks our core growth equity in the top 10 for the last 10 years. Now, when you look at that top 10, you're going to recognize almost all those names in the top 10. And you're going to look at the top 10 and say, Curran, who is that?
How did those guys
How did
get
we
in
get
there?
in? Right, exactly. So our core growth equity has a track record that goes back 25 years. And during that 25 years, it has outperformed the S&P 500 net of fee. And when you rank us among separate account managers, that is, people who buy individual securities on behalf of their clients and subject that to performance standards, the way you would look at a mutual fund, for example, and see how much they've grown over the years, who subject themselves to those standards. We're in the top 10 over the last 10 years. And Lipper, in this particular area, only does 10-year numbers. If you were to go back, we'd be in that going back even more years. So what we do, I think, is working, and it's verified.
Correct. We also are in the top 10 for the last trailing 12 months and 5 years as well.
As well. And we own a lot of companies that people wish they owned but never did. In that list are companies like Apple, Google. We've owned them for quite a few years. And there are some companies that may not be so well known. What might give us a couple examples of the not so well known companies that we own?
Well, companies that people may know, but not even realize they're publicly traded. Toro, if you have a lawnmower or snow blower in your shed, very possible it's Toro. People might not also realize that Toro makes farming equipment as well. That's a company we like and has done very well for us. Monster Beverage is a company that I like to point to often because one of the first lessons you taught me was you don't have to like a company's product for it to be a great investment. I remember trying Monster Beverage and I gagged and threw the thing away after pouring it out on the sidewalk. They were giving them away for free outside a baseball game. And I thought, wow, we've got to sell this. Who's drinking this? But Monster Beverage doesn't exist to cater to my tastes and needs. And clearly it's found a niche for its marketplace out there. And the company is one of the 5 best performing stocks in the S&P 500 over the last 25 years. I don't think many people would pick that. It's certainly not an obvious choice.
Kevin, talk a little bit about what we found to be true about our investment strategy in terms of what is popular right now among the environmental, ethical concepts for investing.
Sure, ESG, right? It's become a political hot button issue, which was likely predictable as soon as BlackRock started marketing themselves as sustainable. So you have big business, then politics intersecting. It's always entertaining, for lack of a better word, if you're offended by that. Likely to be making headlines soon in your newspaper, whether it be the Wall Street Journal or the New York Times. We have learned that our companies that we invest in tend to score well on measures of environmental, social, and governance standards. It was not a deliberate choice by us. It simply, we discovered that it was a byproduct of our natural process. And what I found is the best companies, which we like to identify as having consistent profitability, strong returns on shareholder equity, and clean balance sheets, which we measure by low levels of debt leverage, tend to score well on these measures. If you think about it, it's actually intuitive and makes perfect sense. If you're a company where your employees are happy to come to work and you're well managed by strong governance standards, it would stand to reason that you could be a good corporate citizen in the marketplace. If you are a company that's highly levered, lots of debt, struggling to pay its suppliers, struggling to provide raises and bonuses to your employees, environmental standards may not be the highest priority to operating your business. You're simply concerned with trying to keep the lights on and run the business on a day-to-day basis. So at first we were surprised, but then when digging deeper and analyzing it, it seemed to make perfect sense.
What we found is that we were ESG and we didn't know it. We realized it when we were invited to propose portfolios. When we went to propose the portfolio, we realized in many, many cases we were already ready for it. That's what we were buying. And I think what we found is that we found what is true for large companies to be true for smaller companies as well. So we apply the same standard when we're buying small stocks, mid-cap stocks, international. We apply it to everything and have found that the results tend to be good, contrary to what a lot of people believe. That is, once you twist your investment strategy to be something that is not the norm, you sacrifice returns. And we have not found that to be the case. Surprisingly, have not found that to be the case.
Correct. We should note that we have begun to offer our clients a sustainable equity portfolio because of client interest and demand. It's something that we find a lot of investors are pleased with. It's something they are demanding and want. It doesn't mean that it always works. The last year would be an excellent example because the companies that did best, fossil fuels, defense companies because of the war in Ukraine. So there will be times that they fall out of favor. But what happens is the longer your time horizon, I think the better the results and returns. I am a believer that you don't need to sacrifice long-term results by focusing on ethical investing.
Right. We happen to be there because that we found ethical investing to be a good way to go in the kinds of companies that have sustainable earnings, sustainable programs for capital. That is, they use equity. They don't borrow a lot of money. And
Right.
it's worked to our benefit. Talk a little bit about what we found to be the case for tax efficiency. We don't turn over nearly as much. We don't buy and sell nearly as much as our competitors do. We never sell a stock to simply buy another one. We don't fall in love with something and say we're going to have to buy this. Where are we getting the money? We just simply don't sell to buy. We found that to be works for us. One of the things that I think, Kevin, you know and I know is that we have to sometimes sell the smaller companies that we buy because they get too big. And
Right.
We do try to say to our clients who say, Tom, Kevin, and Curran Wealth, we want you to buy small cap companies. Well, what do you do when they get too big? That's a problem, isn't it?
It is. It is. I like to think of it as graduation. If they get too big for a small cap portfolio, they can graduate to mid-size portfolio or a large size portfolio. But I should clarify for the listener, what does that mean? You had me start by talking about our flagship strategy, which is core growth, and it consists of large companies. Through client demand and interest, we have developed strategies, what I refer to as down the market cap spectrum among mid-sized companies and smaller companies, meaning we create portfolios around our criteria with size being a determining factor. Why do this? Do I need more than one portfolio? Well, over time, it's been shown that there is what we call a size effect with investing in companies, that if you have a very long time horizon, you can earn an extra return over and above large companies by investing in small companies. There's an added element of risk to that, and small companies could also underperform for extended periods of time. We happen to be in a period of time where large companies are dominating, and that has been the case since 2020.
Kevin, you bring up a good point. Sometimes we're all confused, individual investors as well. The market is made up of many, many markets, and sometimes specific areas are doing extremely well and others aren't doing so well. We've learned that to be patient. I think patience is one of our main strong points. But sometimes you can be right in the long run and very, very, very wrong in the short run. And that's particularly difficult to deal with when it seems like the market's going up, but maybe small cap stocks are going down, or small cap growth is going down, or whatever. Pick a segment.
Right.
And it's very, very important to be able to not just see it and understand it, but to be patient.
There are some frustrated investors this year because dividend income stocks are suffering and lagging. Why would that be the case? Dividends make up a significant amount of a total return. Total return is two components. It's the price return of the stock. In addition, it's that dividend that's paid by the company, reinvested by buying shares, that makes up a total return for a company. This year, companies that pay dividends are suffering. are lagging the S&P 500 significantly. A lot of investors are perplexed and confused by that. Why would that be the case? Inflation, higher interest rates. If you can get 5% on a 1-year T-bill, all of a sudden now investing in Procter & Gamble, to name a company, or a McDonald's that pays a nice dividend that's grown at solid rates over time doesn't look as exciting or as attractive. That doesn't mean you sell all your dividend stocks and then pivot to what's working well, because this will prove transitory. But it's the nature of the market, and it's where investors can often be their own worst enemy because they sell low and buy high, chasing whatever is doing well at the moment. And that's something that we fight ourselves. But as you've taught me, being a good investor and having success and meeting your objectives and goals is more discipline than skill, intelligence, IQ. Oftentimes people tend to outsmart themselves, convincing themselves, okay, Israel's going to invade Gaza. What is that going to happen as it ripples through the market? Well, as another mentor taught me once, the 3 most refreshing words in business are, I don't know. And if we're honest with ourselves, that is often the answer. So we revert back to first principles. What do we know works? And quality investing in companies that have consistent profitability, high returns on shareholder equity, low levels of debt, works over time.
They endure.
They endure. Quality endures.
I like to say that it's important when you're investing to know what you will do before it happens. And if an event it would cause you to sell a company, our approach would be, why would you want to own it in the first place? These events are popping all the time. The fireworks are always shooting. And we like to say we want to know what we'll do before it happens, and that would be hold and buy more. And it's hard. It's easy to say that. It's very difficult to execute it. Kevin, the one thing I want to cover a little bit, because people may be thinking, well, we don't own bonds. Well, about 30% of our assets under management are in bonds. We have significant bond holdings. And so I'd like to talk a little bit about that. We do hold bonds. Typically, our investors have 30% or more of their assets in fixed income. We focus on short maturities, higher quality. We never invest in long-term bonds. Now, one of the reasons for that is, quite simply, we are looking at what we call the real return. The real return is the coupon, or the rate of interest, less inflation. And typically, that number is a negative number. That is, the rate of return we earn in a fixed income security doesn't meet the inflation rate. So we own bonds. We own them because they reduce volatility, allow us to draw on cash or cash equivalents or a less volatile asset class when and if we need it. So people say to me and say to you, I'm sure, why don't you like bonds? Well, we do like bonds, but we like bonds in terms of what do we expect from them. We expect a rate of interest. We expect less volatility. We expect no growth, because in the first podcast, and I'll kind of refer to that, I talk about what's a penny worth if invested in 1776. A penny in any period is a penny. A penny today is a penny. A penny in 1776 kept in cash or cash equivalents is worth $1 or so today. The penny at 5% is worth a few $1,000s, but a penny at 10% is worth more than $100 million. And so when we're investing money for our clients, we don't expect a 2 or 3 or 4 or 5% return to do something that it hasn't ever done in the history of mankind. But that doesn't mean there isn't value to it. There is value, but the value has to be understood in terms of what its job is. If you're looking at a football team, you don't expect your offensive lineman to be as spectacular and athletic as your quarterback. That doesn't mean you don't have offensive linemen. And that goes on in life and investment portfolios and everything. There's a purpose. At least for most people, there's a purpose. And we try to align that purpose with the investment goals of the client, the suitability and risk ability, how risk averse the client is, and we try to package that, put it together in a way that allows the client to maximize the rates of return. And so we do like bonds, but we don't expect them to do something they can't do.
Right. You could own bonds really for two reasons. You always start with that premise, right? Why am I doing this? You own bonds to reduce portfolio volatility, reduce risk in the portfolio. Until recently, bonds didn't really offer much of an income potential because interest rates being so low. And now you could look at bonds for income as a possibility. The big moment in investing right now, and people don't even realize it's happening, and they'll be talking about it 5 years from now as if it was obvious. The transition, the rate transition, as you like to talk about, interest rates move in very long cycles. So they peaked in 1982, and they finally bottomed in 2020, near zero during the height of the COVID pandemic. Since then, they've been rising. It's clear that the trend is broken. Rates are no longer declining in a secular decline. They're now in the early phases of an increase. Is this going to last years, decades? That's a bit of an uncertainty. But what investors are learning the hard way, again, is that you had an extended period of time where it was easy to invest in bonds, because when interest rates go down, prices go up. Now that interest rates are rising, bond prices are declining. There's an inverse relation between the two. Many investors didn't realize that. In addition, the other thing that investors have gotten very used to in the last 20 years is that fixed income bonds, particularly long-term maturity bonds, tended to go up in price when the market was in decline. That has not been true now for 2 years. So people are seeing their stocks and bonds move more in alignment together. What is the implication then for investors? They lost sight of the fact that bonds can be risky, particularly long-term bonds. You're tying up your money for an extended period during a period of rising rates, falling prices. You sell the bond at a loss, you reinvest at a higher rate, you rationalize it, and you do the same cycle over and over again because the rates continue to climb higher over time. Every time you have a liquidity event, you're selling the bond and reinvesting at a higher rate, but you're still realizing a loss on the sale of the bond. That's why we focus on short-term maturities, and fixed income. Bonds and fixed income can still work, but you have to have a complete change in your approach to how you're looking at investing in this asset class.
Kevin, I think we could talk a long time about fixed income and how it should be woven into a portfolio, a portfolio that's designed to work over the long term. I want to really thank you for being with us. Certainly, in the Investing Ahead podcast, there's a lot to talk about regarding investment strategies and what we do and how we see things. So I want to thank you very much, Kevin, for being here and contributing to this. And I do have to tell everyone out there that who have children, probably the most difficult thing to do in my life was to bring my son, a child of ours, into the business and have them understand that I'm no longer your father, at least from 9 to 5. I am the boss. And all those questions and dealing in what I would call a new environment, it's difficult. And so any of you out there who have children and are thinking about them coming into a business, I don't think I've implied anything you didn't already know. It's a totally different learning experience. And quite frankly, Kevin, I think it's made you a better person. I know it's made me a better person to understand that and to learn to appreciate it. I thank you for watching this podcast. This is Tom Curran. Goodbye with thanks.
Thank you for watching and listening to the Investing Ahead podcast with Tom Curran. Look for the Investing Ahead book and audiobook available everywhere. Executive producer Brendan Kennedy. Directed and produced by John Wager. Engineered and edited by Adam Russell and Aided Fitzsimmons. Filmed and recorded at Galileo Media Arts Studios. Copyright 2024 Thomas Curran. All rights reserved. For more information, visit investingaheadpodcast.com.